10 questions that you should be asking before you buy a fixed index annuity. My name is Colin. If you get value added today, make sure you hit the subscribe button. With that said, let's jump right into this. All right, so let me tell you the inspiration of why I came up with this title here. You know, if you go online and start researching about different topics or different ideas around finance and retirement, you're gonna get a whole host of opinions. I'm just gonna assume that you've done the research and that you've arrived to the conclusion of, hey, I think a fixed index annuity could be the right fit for the job. Now, from there, we want to look at, okay, well, how do we filter out to make sure that you're making the right decision? Or what questions have you considered or not considered when deciding if this is the right route to go? And that's what we're going to jump into today. So, starting off with number one is, what problem are you solving for? Okay. I'll give you a story. You know, growing up, I used to work with my dad in the summer. He was a plumber. And I'd also work with my grandfather, who was a construction worker and mobile home inspector for over 30 years. And when I go on these jobs, let's say with my grandpa, whether it was a room addition or a tear down or a repair or, you know, an inspection, he would have a tool belt. And his tool belt had different tools, right? And depending on the job he was approaching, he would select the right tool. So it would be silly for, say, someone like myself to have a tool belt and grab a hammer when the job called for a saw. Does that make sense? And the same thing goes for retirement. You wouldn't want to grab one financial tool or product or service or whatever and then use that when something else would be better. Does that make sense? So when considering a fixed index annuity, is one of the first questions you want to ask is, well, what are you trying to solve for? What is the issue at hand? Another way to look at this is, well, what keeps you up at night about retirement? Or what concerns do you have? Or, you know, when you look at your overall picture of retirement, what's missing? And I'll tell you, when I ask my clients that, I get various different answers, but many common ones are, you know, I'm worried about running out of money before I die. I'm worried about, you know, volatility, or I want to be diversified, or I've heard the benefits of annuities and all that they do. So whatever the answer that you get, make sure you get really clear on what problem you're trying to solve. From there, we can then move on to, say, number two, right? Which is, what percentage of your portfolio are you considering using to fund this annuity? Now, I want to make a disclosure. There are some agents out there that when they hear the word annuity and you're sitting in front of them, they're thinking, oh my gosh, I'm going to get a sale, right? Let's just be honest. And sometimes you'll see agents make a recommendation of moving their client's entire retirement portfolio into an annuity. So let's just squash that from the get-go, that is not a wise move, and I would not recommend that, nor would any professional agent recommend that. We would categorize a person who would do that as an amateur and probably won't stay in the business very long. However, when it comes to your goals, right? What percentage of your annuity of your retirement are you considering moving into this annuity, right? So again, kind of problem solving, right? You know, when I have a task or a problem I'm trying to solve, one of my favorite things to do is to work backwards of it, right? Like, let's say you're putting together a weight loss goal. Okay, you want to lose 20 pounds. Great. When do you want to lose 20 pounds? By when, right? And the more clear we can get on that, then we can work backwards and put the right systems in place to reach that weight goal, right? Well, when it comes to your percentage of how much you want to put into retirement, into this annuity, you know, there's not a right or wrong answer necessarily, but an idea would be, hey, you need X amount of income in retirement, and a fixed index annuity can do a good job of supplementing that income. So how much of your portfolio would we need to move over in order to reach that? Now, if we're getting a number of like 60, 70, 80%, right? Where even though it will get you to that goal, it may not make sense to move that much over, right? So a sweet spot is somewhere between 30 and 50%. That's pretty common. It's not a set rule, but definitely not all of it. And, you know, only putting a small 1, 2, 3%, depending on the size of your portfolio, may not help you achieve your goals either, okay? So just consider that. Next, what are the surrender charges, okay? I'm gonna assume you know what they are, but if you don't, if you're listening here and you don't know what surrender charges are, In order for the insurance company to give you benefits like downside protection, upside growth, lifetime income, and some other various options and benefits that they give you, they need to be able to work with your account for X amount of time. Now, usually when you purchase an annuity, you purchase it for a set period of time, a term period, right, or a contract period. This contract period ranges from 5, 7, 10 years, sometimes up to 14 years I've seen them. Now, I don't typically do anything past 10 years, so my sweet spot is usually 5 to 10 years, but you got to ask yourself, what are the surrender charges? So a surrender charge only takes place, this is very crucial to understand, that a surrender charge is only applied to you if, one, you cancel and surrender your entire policy before the contract ends. So let's assume you got a 7-year annuity contract. In year 3, you decide, hey, I want to cash this thing out and I want to go, I don't know, to the Bahamas, right? And go chill out for a couple years. Well, you can do that, but because you're canceling the annuity before the term length is up, then you may incur what's called a surrender charge. Now, each year that you have the annuity for, the surrender charge percentage will go down. So another example is if you have, let's say, a 10-year annuity strategy, usually that'll be about 10% surrender charge in the first year, goes down to 9, then 8, then maybe at 8 another year, until it eventually reaches 0, right? So after the contract period, you no longer have any surrender charges. That's one way to potentially incur or trigger them, which we want to avoid, obviously. Next is if you say, hey, you know what? I don't want to cancel or cash out my entire policy, but I do want to make a withdrawal. No problem. Most companies allow you to withdraw a certain percentage per year without incurring any surrender charges. So let's just say, though, you say, hey, you know what? I'm allotted to take $50,000 a year for my policy without incurring a penalty, but this year I need $80,000. And let's just say the surrender charge is 5%, right? So you would say, okay, I need 80, but my allotted amount is 50, so there's a $30,000 difference there, right? Well, you're not going to pay the 5% surrender charge on the entire $80,000. You're only going to pay it on the difference between what you're allowed to and what you want to take out. Does that make sense? So, 30,000 is what? Times 10, that's 3,000 and half, that's $1,500. Okay, so that's how much surrender charge minus any, taxes or IRS early withdrawal penalties. That's how much surrender charge that you pay. Those only apply, again, if you cancel your contract or if you take out more than the allotted amount. Luckily for me, I have not had this be an issue with my clients because we do a good job ahead of time of doing the homework, making sure you got other avenues to dip into before you need this money, right? But it is something to consider and ask yourself, right? So typically the lower the term period, the less the surrender charge and the quicker they go away. All right, number 4 is what fees will I pay or what rider charges are there? So a lot of annuities today offer the ability to add extra features, right? If you go buy a car, what do? They say, hey, do you want the upgraded rims? Do you want the navigation system? I think actually navigation is pretty common nowadays. What else? Do you want the special limited edition paint job? Whatever it is, right? But you get to pick different selections on things that you can add to your car. And the same thing is with your annuity. A lot of times they'll have extra features, enhanced benefits that you can add for a small fee. So a common one that you'll find is a lifetime income rider. Now this is optional in a lot of cases. It's not required you to have it, but in many cases it can make sense because of the great benefit that you get, lifetime income, etc. So let's assume, hey, that makes sense. I want to like that. Well, you need to understand and find out, well, what is the fee for that? Some companies, that's an option that's included at no extra charge. Some companies do charge, and it's usually around 1%, give or take. Now, that if you do end up paying, you usually get some type of guarantee or some type of stronger payout factor if you end up electing the fee option, right? So this is a consideration, right? Because fees are prevalent in just about any financial product you find, right? The question is what do you get for those fees, right? Because sometimes you're paying fees and there's really no benefit for it. And other times the fee's worth it. So you got to weigh that out. So ask your agent, hey, if I elect this rider, what are the benefits to me? What am I getting? And we'll talk about some other questions to ask around how income is calculated and whether or not it makes sense to do. All right? Which is actually the next one. Number 5 is, how is my income calculated? So again, going down the lifetime income route, you choose that to add as a rider. Hey, it's, I don't know, less than 1% to add, and you say, hey, you know what, this makes sense, cool. Now, is that income, is it hypothetical or is it guaranteed? See, insurance companies, what they'll do usually is they'll say, hey, we're gonna give you 2 scenarios here. One scenario is, assuming it's performed like it has in the past and it does this again, here's how much income we think we can pay you, right? Now that's an attractive number a lot of times, and in many cases it's hopeful, it's wishful, right? We just don't know what the future holds, and we don't know, kind of how that's gonna work out. On the other side though, you have guaranteed income. Now this is showing you, hey, regardless of what the performance is of this annuity, regardless what happens in the world, regardless what's going on in the marketplace, whoever's in office, right? Whether it's a Democrat, Republican, whatever's going on politically, this income is what you can rely on and what you can expect in retirement. Cool. So depending on what your goal is, again, that makes sense, or it's one or the other. Now, usually the guaranteed number, although very attractive when compared to other traditional options, usually the guaranteed number is not going to be as much as the hypothetical number. So just make sure you determine that and figure out if that's the right fit on which one to select. All right, number 6 is, how does my annuity grow, okay? This is a conversation where you're talking about indexes and caps and participation rates and spreads and all this stuff, right? Basically, insurance companies, in my view, right, are some of the most creative institutions to figure out how to come up with ways to make money. I mean, you got to think, like, insurance companies, they're as old as dirt. They've been around in a lot of cases for 100+ years. They know a thing or two about how to make money in different types of environments, right? So the question is, for you, is, okay, well, what are they passing along to me? So one of the most simplest ones is, a lot of annuities will have what's called a floor and a cap, okay? A floor is the protection against loss if the particular index you chose is negative. So let's say you chose the S&P 500 index from an insurance company. Usually the minimum floor for that is 0%. So the worst case scenario in any negative year, you would just earn 0% that year. But if the index does perform, usually there's going to be some type of cap if you're with the S&P, or a limit on how much you can earn that year. Now, right now, it's pretty common to find around 10%. That's at the current environment. That may change a couple basis points less or a couple basis points more, depending on bond rates and what's going on in the economy. So, but for the most part, that's a very simple way on how you can calculate that. So, for example, you have 100,000, market goes down, your 100,000 will stay still. But if that index performs the following year and it does, 8%, well, if your cap is 10, you're going to get that 8% applied to your account value, and you're going to be looking pretty good, and that cycle continues, so on and so forth. Spread. Sometimes companies will say, hey, we'll give you no cap, but we're going to take 5% off the top of whatever it performs at. So that could be a good thing, or it can be a really bad thing, depending on what type of environment, right? If the particular index you chose does 8 and the spread is 5, well, you're only walking away with 3 at that point, right? But let's say you think, hey, we're going to have a monstrous year in the next year or two. I want to select this option. Maybe we're coming out of a recession or a down year, or some particular big event that's happened in the world, and the markets have been struggling, and you think, hey, 12 months, 24 months from now, I think that things are going to turn around a lot. Well, let's say it goes up 20% or 25%, and your spread is 5. Well, now you're getting, the net of that, which could make sense, okay? Lastly, I talked about spreads and caps. One other thing that, you may look at is participation rate. And participation rate basically just means how much, what is the total percentage that I'm walking away with based off what I earn. So another way to look at this is, again, if you have $100,000 and it goes up by 8% and your cap is 10, right? Well, you would get 8%. But if your participation rate was 100%, so you're participating 100% on that total gain. Does that make sense, right? But if your participation rate is 50%, well, 50% gain of an 8% return is what? Is only 4%. Now, why would you choose that as an option? Again, there's certain strategy behind that, so it may or may not make sense to use that. But in general, those are how those types of things work. You need to talk with your agent. A lot of times for me, just to keep it really simple, we usually stick with the S&P option. Now, this is not a cookie cutter suggestion here. Do your own research, talk with your agent. But a lot of times it does make sense because S&P, there's history, you get a nice, decent upside, and you have downside, and the participation rate can't move. It stays at 100%, and a lot of times the caps don't fluctuate a lot. Sometimes they can fluctuate, but not usually by a lot. So that's number 6. Number 7, what happens to your money when you die? That's a really good question, right? I dealt with this recently with a family member of mine that passed away, and they had some assets and they had some things. And, in California where he passed, a lot of that stuff was able to, slide by with a small probate. But if you have a larger account value, right? If you have a larger amount of money and your family's trying to claim this and you don't got a will, you don't got a trust, which a lot of people don't have, which if you don't have, you really should consider it. Then this can be a problem when your family is trying to claim that money. So you want to have a beneficiary listed or have a will or trust in place. Here's the cool thing about annuities, okay? Annuities, when you buy one, you have to list a beneficiary. Usually it's going to be your spouse, your kids, or something of that nature, right? You can list your trust if you want to. And when you pass away, any amount that's left over in your account value is going to pay out to that beneficiary, right? Now, this goes contrary to what the common belief is around old school annuities. Old school annuities, when you elected what's called annuitization, what would happen is you would hand over a portion of money to the insurance company and then they turn around and give you an income stream from it, right? So let's say you handed over $500,000 and you took 2 years of income. Well, when you passed away, let's say in that 2 years, the insurance company would keep the rest of the money. Ouch. And guess what? It turned off a lot of people. And to be square with you, yeah, that doesn't sound exciting to me. I wouldn't do that either. But guess what? Modern annuities today, they don't do that, okay? We use something called lifetime income, as we discussed earlier, the right lifetime income rider. And so what that means is that any leftover account value that you have, minus any distributions you took, will pay out as a death benefit to your family, and they avoid probate, which is a blessing. If you've ever been through probate, you don't want to go through it. It is not fun, but annuities will avoid that. So that's a question that you should ask. Now, there are some annuities that still do that, that do keep the remainder of the money. So make sure you clarify that with your agent because that may not be something you want to do, okay? Number 8, we did talk a little bit about this, but it's what is my liquidity, okay? What is the liquidity with your annuity? When it comes to annuities, look, if you're saying, hey, my goal, like we talked about what problem you're trying to solve, and you say, my goal is, I want to be able to put money into this and then take it out next week and put it back in. And if I want to, go make a purchase and this and that and use it like an ATM or a bank account, right away we're going to say, yeah, the problem you're trying to solve is not good. An annuity is not a consideration for you. Why? Because liquidity with annuities, a lot of times is not going to be the most liquid thing that you can get, right? Think about a CD. When you get a CD, you're locking in your money for a period of time, right? A term usually. Now, if you want to cancel it, you may lose that interest or may incur a penalty. Same is true with an annuity, right? Now, a lot of annuities do have some liquidity, usually around 10% a year, some more, some less than that. So each year, if you want to say use 10% of, you got $1 million in there, right? cool. You can use $100,000 in there without incurring a surrender charge or a early withdrawal penalty. Fair enough. But this is why, again, homework is important, and this is why an agent needs to do a good job of researching with you. Hey, is your assets, do you have liquidity? Do you have emergency savings? Do you have things to dip into so that in the case of an emergency, right? Because look, we can plan all day and then something doesn't go according to plan, right? And then you're like, oh crap, what am I gonna do? So we wanna avoid that by figuring out, hey, do you got savings? Do you got other things in place that you don't have to dip into this annuity for in case of that situation, right? So figure what that is. What is the liquidity with your annuity? Again, some more, some less, just kind of depends on the company and the product. All right, number 9. What is backing my annuity? Which insurance company or what type of insurance company is backing my annuity, okay? So we've seen recently, just a couple weeks ago, Moody's came out and downgraded the credit rating system of the United States government. Why? Because of their excess spending and a lot of different things. Now, this is not the first time this happened. The government has been downgraded a couple times before in the past by different credit rating companies. But Moody's, right, just came out as the final of the 3 and said, hey, we're downgraded. Now, it sounds really bad, but you know, they're still in the A category, right? So they're still quote unquote strong, I guess, right? But when it comes to insurance companies, okay, they are also rated by the exact same credit rating institutions, Moody's, Standard & Poor's, right? There's another one that will come to me in a moment. So, you know, you want to ask yourself, okay, I'm considering this annuity. What is the credit rating of this company, right? And you can actually go see from these different institutions and they'll tell you, hey, this is an A-rated company, this is a B-rated company, this is a B+, this is an A-. Here's their liability, here's their assets, and you can actually see that in a very clear upfront. Actually, most insurance carriers on their front page, you can easily access it, you just go to the About section and you can go look at their financials. They're very transparent about it, which I like. And another thing to consider is, you know, when you look at like banks versus insurance companies, a lot of times people like to compare them. Well, they just operate differently, right? Banks, they, you know, for every, let's just say hypothetically, for every $10 that they have, that they lend out, they only have to have, you know, a couple dollars backed up in reserves, right? It's called fractional reserve banking. If you want to learn more about that, read the book, Creature from Jekyll Island. Very fascinating book. It's a lot, right? So be prepared. Maybe you got a long road trip or something. Go listen to that. You'll never look at the banking system the same. On the other hand, though, insurance companies, they operate off reserves, right? So they got their liabilities, their policy holders, what they have to pay out, and then they got their general fund, right? And their general fund, they have to have many times more of what their liabilities are in order to operate effectively. So their idea is, hey, we want to be super reserved, super secure, super cushion, super liquid, that in the events where we need to actually meet our commitments, we can do so, right? And if they're an A-rated company, chances are they're going to be in the best possible position they can. Now, for those that are very skeptical, well, what happens if the insurance company goes down? I always say, when's the last time you've heard of an A-rated, legally reserved life insurance carrier just ceasing to exist? Once in a while, I'll get people to say, well, what about AIG? You're right. AIG did have some trouble, but it was their mortgage division that suffered, not their life insurance division. As a matter of fact, AIG actually was around for a very long time afterwards. I think they recently spun off their life insurance division into another company. But they were around for after the financial crisis, right? So they didn't cease to exist. Unlike banks, right, where hundreds of banks ceased to exist or got bought up or eaten up during the great financial crisis. So just some contrast there when it comes to banks versus insurance companies. But who's backing your insurance company? Ask yourself, are they A-rated? That's a big one. All right, last but not least, is the person selling you or promoting or teaching you about the annuity, are they offering you what's best for you, or are they just trying to make commission? I think it's appropriate to ask this question in any buy-sell scenario, right? Like when I go to, I just made a purchase recently, and that's one of the things that I'm looking at. I'm helping look at, like, okay, yeah, I get you got to get paid too, totally fair, but I'm buying this, I'm paying money for it, right? What are my benefits too, right? I'm also helping someone make a large purchase on something, and we're going back and forth, negotiating, figure out, and I'm telling them, no, you got to tell them this because they're just trying to hold on to the commission. Look, I'm in the sales business. I've been in the sales industry for over 11 years and counting now, in the insurance industry. Prior to that, I've been in sales since I was 13, 14 years old. But it comes to a point where it's like, hey, what protections do you have, and how do you know whether this person's just trying to sell you something versus doing the best thing for you? So I'm going to give you the emotional side, and then I'm going to give you the technical side, okay? On the emotional side, look, you ever heard of something called vibes? You ever heard of something called your gut reaction, right? When you go into a situation where you're considering buying something, you know it, right? You feel if this person's really trying to help you versus just trying to hustle and make $1 off of you. I have a simple rule. When I'm going to go make a big purchase, if I don't like the person I'm dealing with, I ain't doing business with them. I don't care how good the deal is, because I don't like I don't like their personality, or I don't like how they're treating me, or I think that they're getting frustrated, or whatever the reason is, right? I don't want to give this person my money. So it doesn't matter how good the product is. For me, we're not doing business, right? So gut reaction, right? Your instinct. Is this person giving me slime ball vibes? Is this person giving me bad energy? Like, and is this going to be my agent for the next 10 years? You got to be honest with yourself on that. Okay, so that's the emotional side. Technical side is, look, don't get me wrong. There are some bad apples in the insurance industry. There are some bad apples in the financial industry as a whole. There are some bad apples in the sales industry. There are bad people in general, right? So there's just how the world works. However, what you should know is, in the insurance industry, a couple things. As of the writing of this video, or the filming of this video, most states have adopted what's called the NAIC Best Interest Standard. What does that mean? That means that an agent recommending an annuity to a client cannot recommend an annuity in the following manner, okay? They can't say, hey, Mr. and Mrs. Client, buy this annuity, and because, hey, you said that you're worried about losing money in the market, the annuity is the only thing for you, right? And they're just trying to sell you this product simply in the name of making a compensation. They cannot do that. If they get called on it and they can't provide a good foundational, a good factual evidence of, hey, this is why I recommended this product, they're getting terminated, their license taken away, fined, and possibly even jailed. I've seen it happen. They don't play with this stuff when it comes to real consumer complaints, okay? So that's number one. An agent can't just recommend an annuity simply because they want to be compensated. The other thing they can't do is they can't say, hey, I know about company A that meets the client's objective but doesn't pay me very well, versus company B, which, yeah, it's still good benefits, but it pays me better, right? So me as an agent, I can't go with option B because I'm forbid to go against what? Your best interest when it comes to that, right? Now, this is not a fiduciary standard. I'm not securities licensed. There are people out there that are securities licensed, and they have a fiduciary standard, which is a little bit different in terms of their standard of what they can and can't do. But in terms of the insurance part, the fixed indexed annuity part, they have to abide by those best interest standards. Another thing is, they have to make sure they take lots of documents, figure out your objective, suitability. There's multiple layers that go into this. It's not just something, hey, let's just pick this off the shelf and give it to you, right? So, kind of look at those two things there. Now you might say, well, a financial advisor, they're actually a fiduciary, and they actually are legally required to do everything in my best interest. You're right. And that is the highest standard that I'm aware of, where that comes down into the financial industry. However, that doesn't guarantee that you're still dealing with a good person, right? You can still get a bad apple. You can still get someone who's not competent. You can still get someone who's just underlying, or they're just trying to make a dollar. That's still always a risk. Less of a risk, but it's still a risk, right? So you just gotta, go in there educated, right? I remember anytime I make a purchase on something or something that I want to invest in, right? I go in with questions, and I get the answers to those questions before I go into the meeting. But then I ask the person I'm dealing with too, because I want to see what they say versus the research that I've done, right? If they have something contradictory to what I found, I want to know how they arrived at that conclusion. Hey, okay, cool, you recommend this product for me. Well, why didn't you recommend X? And see what they say. And if it's like, interesting, okay? You're keeping that in mind. Hey, I understand that some annuities do X, Y, Z. Why is it that you're recommending me this one? Hey, that's a fair question. Here's why we're doing that. You mentioned X, you mentioned the. Okay, good answer, right? So you have to ask those things. Okay, so those are the 10 questions I feel like you should ask. If you have other questions, let me know in the comments below if I didn't address them. One more thing that I want to add is a bonus question. And this is a question for yourself, okay? And that is, what is my F.I.N, okay? What is that? Kind of a weird name, right? But it's your financial independence number. A lot of people think, retirement is just for when I turn, retirement is when I turn 65, just automatically it'll happen, right? Not necessarily. Retirement is not so much an age as it is really a number, right? It's where your income is coming in passively and exceeds your expenses. You can technically retire, right? That can happen in your 30s, 60s, 50s, but typically in America, we associate that with our 50s and 60s. So the point is figuring out what that number is, what you need to get your financial independence going is very, very important, because when you're clear on it, you're much more likely to hit it. It's kind of like me saying, hey, let's go on a road trip. Where are we going? I don't know, somewhere east, right? And we just start driving. Well, first off, am I even going the right direction? And second off, where's my destination? Where am I trying to land? My likelihood of getting to where I need to go is not very high, right? But if I have a roadmap, if I have a clear destination in mind, then my chances of getting there are much higher. So that's a little bonus. If you want to know how to figure out what your F.I.N number is, I have a free PDF that I'll go ahead and show you where to get. If you go ahead and check out the link in the description, you'll see a link to get a free PDF with how to find out your F.I.N. With that said, love to hear your feedback. Let me know your thoughts in the comments below. And until next time, everybody, thank you so much. We'll see you all again soon. God bless. Bye-bye.